Question number 1. In the preparation of annual operating budgets, the direct material usage budget should directly follow the preparation of which of the following budget? Remember, whenever we start our budgeting process, the first budget we draw up is the sales budget. From sales budget, we draw up our production budget. And once the production budget has been drawn up, we can start any of these three budgets immediately after the production budget. So, direct material purchase budget, sometimes called direct material usage budget, direct labor budget, and the manufacturing overhead budget. Since we need to see which of the budget we need to produce before we can draw up the direct material usage, that is the production budget. So, we need to first have the production budget, only then we can draw up our direct material usage budget. So, that means option C is correct, production budget. Next, the stakeholders of a local family-owned gutter installation company includes all of the following. First of all, you need to know who are the stakeholders. Stakeholders are people or groups that are affected by what an organization does, that are affected by the organizational activities, organization outputs, outcomes. This question is basically from your integrated reporting. So, which of these is not a stakeholder? Customers of the company, yes, they are. They are external stakeholders. Employees of the company, yes, they are stakeholders, internal stakeholders, because they are within the geographical boundary of the company. Supplier of the company, yes, they are external stakeholders. Residents of the neighboring state, that is not right. They are unrelated, since it's a family-owned business, not a PLC. So, most likely it is within a certain state. So residents of a neighboring state, that is least likely. This is least likely a group of people to be the stakeholders for this company. Okay, so C is the answer. Moving on to the next question, and this one is a bit bigger, more likely. So, what you should do on your exam, try to do as many shorter questions as possible. And once you are done with at least 30 to 40 short size questions, just like these, of course, you can get such questions on your exam as well. One-liner, there are many one-liners. There could be many one-line questions. So try to attempt as many as you can. Once you are done with 30 to 40 small size questions, you will gain confidence, right? Let's say if I were writing the exam, I will skip this question. I will do this. I will skip this question, skip this, do this. Once I'm done with smaller questions, 30 to 40, at least I have done the bulk of it. When the remaining time is available for me to fight with the longer questions, then I can go for it, right? So always use this strategy. Try to attempt as many questions which are of shorter size as you can, so that you can gain confidence, and then you can keep the remaining time for the longer questions. Okay, so this question, we will have to do them all sequentially, but I will tell you, whenever a longer question is there, which will take time in reading and understanding, instead of just wasting 5-6 minutes and getting under stress, skip it. Come back later once you are done with at least half of your exam. Okay, question says, this question, I guess it relates from process costing and involves some spoilage. Carlos company manufactures a single product called CX. The production process also yields a waste material called WX. During July, 6,000 units of raw materials costing this much were put into production. So we have direct material is equal to $36,000. And out of these 6,000 units, only 5,400 units are good units. The remaining 600 units of output were wasted, which must be disposed of at a cost of 2.7 per unit. Other conversion costs incurred during the month of July were 28,800. 28,800, this is the sum of direct labor and your manufacturing overhead, which is collectively called as conversion cost. Alright. The question says, what is the manufacturing cost per unit of CX? Now, most of you, what you will do, you will take the cost of direct material, conversion cost, and you will divide it over these units, 5,400. This is incorrect, because these units which were wasted, they must be charged to good units, unless it is specifically mentioned that these are abnormal spoilage. The question doesn't say so. It's the waste that is expected, right? A process also yields a waste material. Since it's a part of production system, it is expected wastage, expected spoilage, it is normal spoilage. The cost of the normal spoilage is charged over good units. So this cost, which is going to be 2.7 times $600, will be 1620. So this cost of normal spoilage must be added to the cost of good units, and then add these all up and divide with the 5400 good units produced. The cost per unit is going to be 66,420 divided by $5,400, and this should give you 12.30. That makes A to be the correct option. So this is an important point. Normal spoilage is considered as a part of the cost of production. Next, manufacturing input costs are accumulated in the accounting information system. That is the topic related to information system, section F, technology and analytics. So manufacturing costs are accumulated in accounting information system. Where, in which specific section? I'm sure most of you would have got it. Manufacturing input, that is the cost of material, labor, overheads. It is a part of your cost accounting system, which is itself a subset of management reporting system. Without doubt, A is the option. Why not B, C, D? You should have a good reason for rejecting these. Responsibility system, that is your section C, generating performance report for different segments, different geographical regions. It is a part of management reporting system, not financial reporting. So this is incorrect. Production reporting system, how many units did we produce? This is more related to day-to-day operations, so it's not part of management reporting system. Incorrect. And finally, profitability reporting system, which is a financial reporting system. This is correct. But since we are specifically talking about manufacturing cost input, so this is not a part of your profitability reporting system. So, A is the answer. Next, bigger question. Jump to next question. Longer, jump further. Do this one. Skip, move forward, skip, move forward, skip. Try this one. Try, this is the way you will tackle longer question. This clearly relates to your process costing. Let us read this question first. Juniper Manufacturing uses weighted average process costing system at its satellite plant. Goods pass from the major assembly department to finishing department and then to the finished goods inventory. Fine. The goods are inspected twice in the finishing department. The first inspection occurs when the goods are 30% complete, and the second inspection occurs at the end of production. The following data pertain to finishing department for the month of July. What exactly are we looking for? The question says there was no beginning work in process in July, means beginning work in process is 0. Juniper recognizes spoiled units to make the cost of all spoilage visible in its management reporting. Now this is a very interesting piece of information, because so far we have discussed that all the costs related to spoilage is split into either normal loss or abnormal loss. But in this company, in this organization, they recognize all the spoiled units to make the cost of all spoilage visible to the management reporting. So basically we are talking about the management reporting, not the financial reporting, because in financial reporting, the cost of spoiled units, abnormal spoilage are not charged to production. The cost of normal spoilage, it is kept within the cost of production. So this specifically is from the management reporting point of view or management accounting point of view, just for the purpose of management reporting. So this is a deviation from our normal practice. Okay. So I'm sure most of you know the way I solve process costing question. You have to split your cost of production units into 3 classifications: beginning work in process, units started and completed, and the ending work in process. And then you go for accumulating your different costs. So equivalent units used for assigning costs for July. Please remember, this is a very unique question. Here the spoiled units are considered in costing to make the spoilage visible to the management reporting. So we are talking about the management reporting, not financial reporting. In financial reporting, losses are segregated. Abnormal is treated separately as a period loss, normal spoilage is kept within the cost of good units produced, right? So it says that there are two stages of inspection. One, then goods are 30% complete, other when they are 100% complete. First, good units started and completed during July, 65,000, so they will fall in this category. Units started and completed. Beginning work in process was nil as per the question given. Now this is interesting, this part. This company, this organization considers all normal and abnormal spoilage to make the loss visible. This is not the right treatment, but this is for the management reporting. You can do anything in management reporting, whatever you feel like, whatever you want to do, you are at liberty. So normal spoilage, first inspection was done when the units were 30% complete, which means the equivalent unit of normal spoilage was 2000 times 30%, that is 600 units. So they will become part of this cost, this equivalent units. Then abnormal spoilage, second inspection when they were 100% complete, it means from a completion point of view, 150 is 100%, they are 150 equivalent units. And any work in process which is 60% complete, so it means if you calculate equivalent units for 15,000, it's going to be 15,000 times 60%, it's going to be 9,000. So you are going to add up all these 600, 65,000, 9,000, 150, all these are 74,750. This is just for management reporting purpose. If I ask you guys, what is going to be the equivalent units you will consider in the normal conventional financial reporting purpose? This is just for the sake of this unique situation. If you are required to calculate EUPs of production, what the number you're going to give? Okay people, under the conventional method, the normal, most of the questions follow this technique, and that is acceptable for the US GAAP and IFRS also. Abnormal spoilage is not considered as a part of production cost. Abnormal spoilage must be removed. So you must not consider these 150 units here. Only these three, your cost of completed units, ending work in process, and the overall EUPs of normal loss. Just these three must be added to give you the right number. So this is the conventional approach. But right now, since we were supposed to find out the total EUP, so this is going to be 74,750. Next question. Whenever you come across a longer question, I always recommend that you should first seek what is needed, what exact is the requirement of the question. In this question, we are required to find out the gross profit, which means we are going to focus our efforts only on the gross profit number. Did we miss anything? Yes, we have already done this one. 6 questions supposed to be done. So we are going to find the gross profit for this company for the next financial statements. So let us see what kind of business it is. Gross profit is to be calculated. Pell company builds new homes on lots that it owns the title to. Okay. The company normally obtains a signed sales contract before it begins construction on a home, right? So it usually does not build on specifications, specs, that is speculatively. It does not build on spec or speculatively, whatever is specifically required by the customer. So it's customized production, construction of the homes, right? As per the customer's specific needs. The contracts contain a provision allowing buyers to change their mind and cancel the contract during the construction period if they pay a fee. They pay a cancellation fee and the deal is over. The customers make progress payments during the construction. Remember, we have to find the gross profit or gross loss. So they pay a fee if they cancel. The customers make progress payments during the construction, but they do not receive title to the property until construction is complete and sale is closed. This is a very important piece of information. You should always look for the key information that is crucial to the right solution of the question. Title is not transferred until the construction is complete and sale is closed, which means there is going to be no sale till the construction is completed. So the following data pertains to Pell's home construction job that commenced during 2005. We have 2 homes on which the contract price is 420, 300 respectively. We have been given the cost incurred so far, estimated cost to complete, and so far it shows that both of these homes have positive profit because the cost incurred and to be incurred is less than the selling price. So yes, there is gross profit, but since this company explicitly follows a policy to recognize revenue only when the construction is completed. So this organization recognizes revenue at a point in time when this contract is fulfilled and the title is transferred to the customer. Since the jobs are in process, so there is going to be no gross profit. Company is going to recognize no gross profit because no sale has been recognized so far. So the answer is C, no gross profit. So please pay special attention to the question's key information, and especially when a longer question comes, read the question's requirement so you can read the question accordingly and get the right answer. Alright, next question. A business lender uses robots to monitor construction projects. Interesting. Technology and analytics, your section F. He uses robots to monitor construction projects. It is financing to help loan officers determine the status of the projects in order to make decisions on when to disburse loan funds for the construction. Interesting. Robots only watch. They only watch. They do not engage in any type of construction work as per the information given. So the lender is using what? Data analytics. We don't see any analysis of the data. Just robot is watching. Maybe it has got some sensory vision and is just taking the imagery, and that imagery is being analyzed by somewhere in the computer system to see to what extent the job has been completed. So there is no data analytics. There is no machine learning. We don't see any artificial intelligence here. We are just seeing here monitoring, viewing. Cloud computing, we don't see anything. No such information has been given. It's machine vision. Robots are watching and sending those visuals and imagery. Absolutely right. Camera vision and giving it back to where the information needs to be relayed. So need to read information carefully. We may just jump that this data analytics section F. No. Look at the specific key piece of information, just monitoring. So there is no analysis, no cloud computing. It's a vision, imagery. So D is the right option. Okay, next one appears to be a good question, an extended one. Again, I would always recommend whenever you see a longer question, just identify what is needed. Under the variable costing, valuation assigned to ending inventory of the finished goods and the cost of goods sold. Fine. We have to find out the value of closing stock and the values assigned to CGS. That's what we need under variable costing. That's the key piece of information. So people, for this you need two things. Number one, you need the units involved. How many units are there? And secondly, what is the per unit cost? I just need these two pieces of information, per unit cost. If I get this, my question is done and I save a lot of time. It says Hudson Company manufactures single product. Shown below are the cost and sales data for the first year of operations. During the year, 10,000 finished units were manufactured. So this is the total production, and of which 8,000 were sold. Great. So that means out of this 10, 8,000 units have been sold and 2,000 are in closing stock. So the first part is done. The next part is I have to find the per unit cost for valuing these units. Okay, people, I'm sure you know what we do in the variable costing. The variable costing, inventoriable cost are sum of three things: direct material, direct labor, and variable overheads, which is collectively called as variable manufacturing cost. Variable manufacturing cost encompasses material, labor, and variable overhead, and these three costs are inventoriable costs under the variable costing, or the cost of inventory includes only these three costs. So I should look for these. I don't care about the fixed. Selling admin is not a part of production cost. This is exactly what I'm looking for. Manufacturing cost variable, that includes direct material, direct labor, and the variable overheads. It's 200,000 divided by how many units produced? 10,000. That clearly means the variable cost of production is 20 per unit. So that means 2,000 times 20 is going to be 40,000 is the value of closing stock, and 8,000 times 20, that is 160. So we got the answer. Valuation of closing stock is 40 and the CGS 160. C is the answer. See, if you knew what is required, you can scan the question accordingly and always get the right answer. So do not just jump on the options. Next, same question, but this time you need something different. Let's see. Question says, using full absorption costing, calculate income from operations for the year. In full absorption costing, people, the cost of production is sum of four things: direct material, direct labor, variable overheads, and fixed overheads. These four costs must be added together to find unit cost of production. So out of these three, we have been given 200,000 for variable cost of production, and fixed overhead is 400. That means our full cost of production, also called absorption cost of production or full cost of production, is $600,000, and this was incurred in producing 10,000 units. So that means the cost of each unit is 60, right? So if you want to find the gross profit, simply take the sales revenue, which is 880. 8,000 units have been sold and the per unit cost is 60. So 8,000 multiplied by 60 will give you the cost of goods sold under absorption costing. So 8,000 times 60 gives you 480. So sales of 8,000 units versus cost of sales of 8,000 units gives you gross profit, which is $400,000. Yes, exactly. Of this $400,000, you need to deduct your selling and admin expenses, 40,000 for variable costs, selling, and 240 for fixed. So if you deduct these two, you will get 400 less 40 and 240, 120,000. So 120,000 is the net income under absorption costing. Let's do this side by side. Let's say, if you were required to calculate the net income using variable costing, this is under the full absorption costing, sometimes called full costing. Under variable costing, what you will do, you will first calculate the contribution. How do we calculate contribution? I hope you would remember from the previous question, your variable cost of production was 20, right? And your variable selling cost was 5. So it means 25 is the variable manufacturing cost and variable selling cost. Selling price is 110. So 110 is selling price, 25 is the variable cost, all variable costs. So the contribution we generate is 1110 minus 25, that is 85. This is the contribution generated by single unit. 85 multiplied by how many units sold? 8,000 units sold. That is 680. So your contribution is 680. Sales minus all the variable costs, direct material, direct labor, variable overheads, variable selling, variable admin. So you deduct all the variable costs. 110 less 85, 25 gives you 85 times 8,000 gives you 680. And from this 680, you will deduct all the fixed costs. There are two fixed costs. Number one, fixed manufacturing and fixed selling and admin. So that is basically 640. So 680 less 640 gives you perfect. See, you got it right. That is $40,000. So under the variable costing, we get 40. Now someone please explain why variable costing is showing higher profit than full costing is showing higher profit than variable costing, and they differ by 80. This 80 can be explained by just a single number. This 80, remember, those units which were not sold, they carry some fixed cost in them. That fixed cost doesn't get expensed in full costing. So that's the reason the fixed cost that doesn't fully get expensed. It becomes part of the closing stock. So part of the closing stock, exactly. So part of the closing stock that bypasses your income statement. That's why your your full costing shows a higher profit than the variable costing. I'm sure you would remember from your earlier studies that this is the way we go about. Let me explain what the idea. Your fixed cost is $400,000. We produce how many units? 10,000. Which means each unit we produce, it carries $40 of fixed overhead. Each unit we produce has absorbed $40 fixed cost. These 8,000 units were sold, 10,000 units were produced. Those 2,000 units which were produced but not sold, those are the naughty units that have manipulated the profit. Those 2,000 units which we didn't sell, each has absorbed $40 of fixed cost. Thereby $80,000 worth of fixed cost didn't get expense. $80,000 worth of fixed cost is hidden as a part of your closing stock, and that is the reason your full costing or absorption costing showing a higher profit than variable costing by the same amount. That's the rationale behind why full costing and variable costing show different results. So we got the answer B, and we also discussed the comparative analysis of full costing and the variable costing. Full costing is also called the absorption costing, and variable costing sometimes also called the direct costing. Done. Next question, and it is about what? This question relates to account receivable management, and most likely we have been given the outstanding customers, estimated credit losses, so we are expected to do some computation here. Before we do that, you must memorize the format of your allowance for uncollectible account. Allowance for uncollectible accounts. We have an opening balance, a closing balance, any bad debt expense charged during the period, or estimated bad debt. Estimated bad debt, please, it's not actual. Estimated bad debt, they appear on the credit side. Any bad debt which was previously written off, if it is recovered, it is shown on the credit side. This is from the topic we just discussed recently. Bad debt recovered and actual bad debt, the bad debt actually written off, they appear on the debit side, and I'm sure you know the entry. So this is what we are supposed to do. So it says the following information pertains to Tara company's account receivable December 31st. We have been given an aging analysis. 120,000 AR is 60 days old. 90,000 is between 61 to 120 days, and 100,000 is above 120 days. And this is the likely credit loss. It's very simple. You will have to just multiply these amounts with these percentages. First number you get is 1200, 1800, and this is going to be 6,000. So this is the, if you add these all up, this gives you $9,000. Clearly, you don't have to look for, this is a balance sheet approach. In balance sheet approach, we take the outstanding receivables and multiply them with certain percentages. We want the balance sheet approach, and this 9,000 is the closing balance of my allowance for uncollectible account. Had it been the income statement approach, let's say our income statement showed a credit sale of $1 million. Under the income statement approach, 3% of credit sale is considered the estimated bad debt expense. In that case, ladies and gentlemen, 3% of $100,000, that is $30,000, it goes as an estimated expense for the period. We do not see what is the balance opening, what is the balance closing. This is the difference between balance sheet approach and income statement approach. In balance sheet approach, whatever the number comes is the new balance of your allowance. Under the income statement approach, credit sales time a certain percentage. Whatever comes is the estimated bad debt expense for the period. Goes right here. Right? Since it's a balance sheet approach, it says that during 2005, Tara wrote off 7,000 in receivables. This is the bad debt actually written off to be reported here. And recovered 4,000 that had been written off in the prior years. This is the bad debt written off, now recovered. It appears on the side as I've just written down the format. Okay. And it further says Tara December's allowance for the credit losses was 22,000. This was the opening balance. Tara December 31st, 2004. We are at the end of 31st December 2005. This is the opening balance, 22,000. Now, this is a very interesting situation. Our net balance, 22,000 was the opening balance, 4,000 bad debt recovery, 26,000 less 7,000 written off. We still have $19,000 balance available in our allowance. Beautiful question. We need a balance of 9,000. It's like you have $19,000 in your pocket and the spending expected is 9,000, which means the surplus extra is unneeded allowance, which must be reversed to the income statement. This is a very interesting question, an unusual one. You haven't done any question like that in any software. $19,000 is the balance after adjusting bad debt recovered and bad debt actually written off. $19,000 is the balance. We need 9,000 balance. The balance available is more than what we need, so extra must be reversed to the income statement as a gain. Because we want provision to be 9,000, available is 19, extra must be returned. Let's see. This is the answer, this is the gain, and this is the answer, without doubt. Let's say, if we needed $29,000 balance here, as per the balance sheet approach, available balance is $19,000. In that case, we needed $29,000 balance in allowance, available is 19, we need 10,000 more. In that case, you would have seen this 10,000 expense here, and in that case, B would have been the answer. In that case, B would have been the answer, but this is not B, this is A. Right, people? So these fine things normally you won't find in different software, so that's why it's recommended to follow these questions closely. Okay, next question says, control objective that would reduce the probability of a credit sale being recorded as a cash sales. Which of these controls would reduce the chances of a credit sales being recorded as a cash sales? Let us discuss these controls one by one. First control is validity check. Please, the validity check only ensures that transaction is valid. It doesn't ensure accuracy. Valid. Yes, it's a sale. Credit sale and cash sales, maybe there could be issue in them, but it's a valid sale. So validity test only ensures the validity of the transaction, not accuracy. Right? Completeness. Transaction was complete. Debit and credit were complete. Debit was given to cash or maybe account receivable, credit to sale. So debit, credit are complete. So there is no issue with completeness. Right? Again, there is no issue of authorization. Only authorized transaction enter into the system. The problem here is the accuracy. Accuracy is a transaction control objective in financial reporting, means all the valid transactions are accurate and are consistent with originating transactions. So the problem here is with the accuracy, that we didn't check the accuracy, because accurate transaction would have been, because the question says credit sales being recorded as a cash sale. It should have been AR debit, sales credit, but instead it was cash debit or bank debit, sales credit. So it was valid, debit, credit were complete, it would have been authorized, that's why in the system. The problem is that it was not accurate, it is disturbing your AR and cash balances. Right? So your cash would be overstated, AR would be understated. So the issue is with accuracy, the transaction is not accurate or it is not correct. That's the main issue. So it's not D. There is no issue of authorization, the issue with the accuracy. So that will make C to be the correct option. Next. This question relates to inventory. What exactly is required? By what amount should Opal inventory account be reduced for the presentation on December 31st financial statements? So we need the right figure, or what needs to be added or deducted to the closing stock number. The following items were included in Opal's inventory account at December 31st, 2005. Merchandise out on consignment at selling price. Merchandise out on consignment is your inventory. It must be added to a part of your inventory. But the problem is it is added at the selling price, whereas the merchandise out on consignment should have been added at cost. You have added markup to it. The markup must be removed. How? 40% of 40,000. This 16,000 is markup figure, must be reduced from your closing stock number. Goods purchased in transit, shipped FOB shipping point at purchase price. These are the items which we ordered to buy. These items were sold on FOB shipping point. So as soon as they are shipped, they are ours, and they are in transit. They belong to us, and they are rightfully included. They are rightfully included, so we don't need to remove them. They belong to us, and they are already included in the inventory number. So there is no need to remove it. It should have been added, and it is already added, and it's fine, no problem with it. Goods held on consignment by Opal. We have some items in our warehouse, but they are on consignment and they belong to someone else. This is the issue. these goods which are in warehouse physically, but they do not belong to us. They erroneously were added to the closing stock of our current assets, so it must be excluded. This is not ours, so must be removed. So adding these two, combining, means you need to reduce 43,000 from your closing stock number. This is for the markup. Goods are put in cost, not at the selling price. And these goods which are added to our inventory number, they are not our items, so must be removed. So this must be deducted. 43,000 is the valid deduction from your account receivable number. Next. Okay, this relates to your IT, business continuity planning. A major mutual fund company maintains a facility separate from its operations center that has the same computer equipment and same data and communication links as are in its regular operations center. In the event of disaster, the facility could be made operational by restoring current data to it. The site is called as what? Remember, there are three sites: hot site, warm site, and cold site. Cold site is just an empty room where there is nothing, just an empty shell facility. Warm site is a facility with the necessary computerizations and telecommunication links as well as software, but it is missing the current live data. And when you say hot site is fully 100% functioning facility where you can switch over in the case of any disaster. So please remember, hot site has hardware, software as well as data. Warm site has hardware, software, MAFI data, and cold site has nothing, just an empty room with a couple of chairs and table. No hardware, no software, no data. It's just a room which we may use for our computer operations. So this system given here, Jagannath, it says that you have hardware, you have software, but you do not have the current data, so it is a warm site. And there is no term as mobile site, just a distraction. So it's going to be C, a warm site where you have the hardware, software, communication, but there is no data, the current data that we need. So it's a warm site. Okay, here we go. Variances. Always look at the requirement of the question so you know what you are supposed to do. Variable manufacturing overhead spending variance. Immediately, the first thing you should do is to take out my formula sheet, which I have shared with all of you. If few of you don't have it, I will share it with you in the WhatsApp group. I have crafted a formula sheet and arranged the formulas in a way that every positive number means a favorable variance. Any number which comes out to be negative in your computation is an adverse variance. So as per that sheet, which you will get soon, variable overhead spending variance is equal to actual quantity of machine hours or labor hours used, machine hours or labor hour, whatever the case might. We don't know what it. I think this is labor hour based. Fine. Actual quantity of machine hours or labor hours used multiplied by the variable overhead absorption rate, which I have referred to as SPV in my formula sheet, minus actual variable cost. I need these three things. How many actual hours of machine or labor were actually used? What is the variable overhead rate? This is the overhead applied. Versus what is the actual overhead? This will give you the variable spending variance. Let us extract what we need from the information given. BASPA company uses a standard costing system. Variable manufacturing overhead is allocated to products based on the budgeted direct labor hours. So it means it's a labor hour driven production. The fixed portion of the overhead is allocated on per unit basis at a budgeted rate. FO sheet is unit based. Variable overhead rate is labor hour based. Okay. The following information was gathered and it further says the rate is set at the beginning of each month. The following information was gathered about the production overhead cost in May 2004. Direct labor hours as per the standard, each unit should take 0.35 labor hour. This is called the standard quantity of hours allowed for the production. You should have taken 0.35 hours per unit, 0.35 hours of labor per unit. Variable manufacturing overhead rate, this is which you most frequently call variable overhead rate, and in my formula sheet I call it SPV, that is standard price of variable overhead rate. This is given. This is the first element we needed. This is right here, 12. Okay, so this is my variable overhead rate, variable manufacturing overhead rate, or variable overhead absorption rate, variable overhead recovery rate, variable overhead allocation rate, whatever term you want to name. This is SPV. Done. Fixed manufacturing overhead, budgeted, I don't care. Planned production was 9500. Okay. These are the actual results. Variable manufacturing overhead rate, actual 11.5. Actual output 10,000 units. What I'm looking for is the actual quantity of labor hours worked. So we are looking for the actual quantity of labor hours used. This is 3550. Actual quantity of labor hours or machine hours if it's capital intensive business. So 3550 would be the input here in place of AQ, that is the actual quantity of labor hour, time 12 minus actual cost variable. Now this is something tricky. You will keep on looking for a single number for actual variable overheads. What he has done, he has played with you guys. He has given you the actual variable overhead rate, which is very unusual. We don't get any rate like that. And these many labor hours were worked, and this is the actual variable overhead rate. Multiplying these two will give you the actual variable overhead. Actual rate multiplied by the actual hours worked. So if you multiply these two, 11.5 multiplied by 3550 gives you 4085. So 40825. 40825, this is the actual variable cost. So this is it. 40825 is the actual variable cost, and 3550 times 12 gives you 42,600. This is the variable cost should have been 42,600. This is what cost should have been as per the actual quantity of labor hours used. This is what the cost should have been, whereas the actual variable overhead is 4825, less than what it should have been. So we spent less. It is clearly a plus number and a favorable one. If you calculate the difference, it is 1775. This is what the cost should have been based upon the actual hours labor used, and this is the actual variable overhead. So this is 1775 favorable, and that makes C to be the correct option. C it is. Next, same question, but this time you need the variable overhead efficiency variance. As per the formula sheet which you guys have, variable overhead efficiency rate is equal to labor hours that you should have used as per the standard allowed minus the actual cost of labor hours used in production multiplied by the variable overhead absorption rate. Just these three things you need to have as per the formula sheet. Actual quantity of labor hours used 3550. But our standard says that each unit should take 0.35 labor hours. If you produce 10,000 units, each unit should have taken 0.35. That means you should have used 3,500 labor hours as per the standard set, but you used 50 hours more multiplied by the variable overhead absorption rate. So you used more hour than you should have. 50 multiplied by 12 gives you a negative number, and I told you negative number as per our formula sheet would mean an adverse variance. So 600 adverse negative, and that is perfectly in harmony with your option B. Okay, so follow the formulas correctly and you will always get the right number. Learning curve. Learning curve. Okay, and I'm sure you know the format, the way we do learning curve questions. You should make 2 columns, sometimes 3. The first column contains units, second column contains total time or total cost, and the average time and average cost. This is a fantastic table. Plug in the numbers, you can always find what is missing. Sometimes we don't leave the last column, but sometimes we do. So how do we populate this table? Reeves Incorporated has developed a new production process to manufacture its product. The new process is complex and requires a high degree of technical skill. However, management believes there is a good opportunity for employees to improve as they become more familiar with the production process. The production of the first unit requires 100 direct labor hours. See, that's why I've written total time, total cost, low labor cost, of course, average time or average cost, labor cost, because learning curve is applicable on labor. So first unit took 100 hours. If the output is doubled, your time should be doubled as well, 2 times 100. But since we are on a learning curve at 70%, if a 70% learning curve is used, the cumulative direct labor hours required to produce a total of 8 units. It means our result will be in this column. We are not talking about the average. Total time for 8 units. So when the output is doubled, our time should be doubled from 100 to 200. But since we are on a learning curve of 70%, the time will be 140. Output is doubled, 2 to 4. Time should be doubled, 140 is 2 times, 280. But we are on learning curve at 70%. 70% of 280 gives you 196. Units are doubled, 4 to 8. Then the total time should also be doubled, 196 times 2. But we are on a 70% learning curve. This is the only method you're going to use in your CMA questions. Eka do, do ka, char, char ka, 1, 2, 4, 8. In ACCA and in CA, we can calculate precisely what is the time for 6th unit only. There is a formula for that. We don't need it. In all CMA questions, you will see the questions where the output is doubled, and this is the way we calculate it. So 196 times 2 times 70% gives you 274.4, and that is C. Every question in CMA will involve learning curve questions where the output is doubled. And that's the table where you can find, if you need to find the average, 100 by 1, 100. 140 by 2, 70. 196 by 4, and then this is the way we can calculate the average also. So for now, C is the answer. Next question is a smaller theoretical question, involves IT, technology and analytics. Which of the following is not a governance issue related to data capture? Mind it, not an issue related to data capture. Not. That's the question twister. Focus on this. Monitoring the company's performance on its contract for data acquired from outside organization. Data acquisition. Clearly it does involve data acquisition, data capture. Yes. Monitoring the function of devices used to receive transmitted data. This again does involve data capture. Here the word acquisition tells us, here the transmission, the data is transmitted through wireless frequency or through cable network or from any other media. So this data input, this is capture. Monitoring accuracy of data input internally through data entry. Again, input. Data acquisition. The word will tell you, because we are not IT guys, but at least the terms should make some sense. Input. So this clearly involves data capture. Acquisition of data, input of data. Look at this. Monitoring the quality and adequacy of input data used in data synthesis. This is a separate stage in the data lifecycle. I hope you would remember there are some steps in data lifecycle. Those who studied section F would know. So this is clearly a separate phase in data lifecycle. Above 3 are engaged with data capture activities, but this last is related to data synthesis, which is a totally different stage in the data lifecycle, and hence this is our answer. Exactly. Next, again a smaller question. The primary responsibility for maintaining a system of internal control rests with not only maintaining, designing, drafting, implementing. Maintaining, drafting, designing, implementing, it's the job of management. Internal control is the prime responsibility of the management under 404, under section 302 of the Sarbanes-Oxley Act 2002. Management is primarily responsible. Internal auditor doesn't design, draft, maintain or implement. Internal auditor only assesses the adequacy and effectiveness of internal control. He doesn't maintain. Accountants are part of management, but when the word management is said, that is more comprehensive than the other. Lawyers, no. Lawyers have nothing to do with internal control. Next. Warranty liability. Now done a format for warranty liability. Once you know the format, inputting will be much easier. Opening balance of the liability. Estimated warranty expense. Please remember, this is the warranty expense estimated. Just like estimated bad debt. This is the warranty expense actual. And this is the closing balance. Okay. So on April 1st, 2005, Ash Corporation began offering a new product for sale with 1-year warranty against defects. Of the 5,000 units in inventory, April 1st, 2005, 3,000 had been sold. Since it's a first product, new product, there is zero opening balance against this product warranty. Out of the 5,000 units, 3,000 have been sold. Based on its experience with the similar products, Ash estimated that the average warranty cost per unit sold would be 8. Estimated warranty per unit is 8. You sold 3,000 units. That means the estimated warranty will be 24,000. You're going to pass a journal entry by debiting the warranty expense 24,000, crediting the warranty liability 24,000. This goes to the income statement and this goes to the warranty liability account. Fine. When the actual warranty cost is incurred 7,000, it is not charged against the income statement. Just like when actual bad debt occurs, we do not charge it against the income statement. We charge it against allowance. So this 7,000 actual warranty cost charged against warranty liability by debiting the warranty liability and crediting whatever you have given. Cash given as a refund, some parts given as a refund, or some labor given as a refund to rectify the item. So people, warranty liability will be debited with the actual warranty cost. So what are we required to do? What amount should Ash report as an estimated warranty liability at the end of the period? So very simple, 24 less 7 gives you 17, and that's the warranty liability balance at the end of the period. A. Okay, so what do we need? It's a good question involving job order costing. Okay, job order costing. What are we required to do? Burnsville Corporation uses a job order cost system and has two production departments, A and B. Budgeted manufacturing costs for the year are as follows: direct material for A, direct labor for B, and for B also. Labor and material for both departments are given. Manufacturing support is also given. The actual material and labor cost charged to job 432 were as follows. So we have a particular job. What are we required to do first? Burnsville applies manufacturing support cost to job on the basis of direct labor cost. This is interesting. Overhead is applied to units of production based upon labor hours, machine hours, labor cost also, prime cost also. So this is one of the way in which the overhead is applied based upon the labor cost, and we will determine the rate first. And the labor cost using departmental rates determined at the beginning of the year. The total cost associated with job 432. Job 432 total cost is to be calculated, and we know it's a sum of three things: direct material, direct labor, variable and fixed combined into manufacturing overhead. Direct material is straightforward given as 25,000. Direct labor in department A and B combined, directly traceable, is 12 plus 18, 20. The issue is this item gets some work done in department A and B, and accordingly manufacturing overhead will be split from A and B. For this, first we have to establish a manufacturing overhead rate for department A and B. And how is it calculated? Pay special attention to the words. Manufacturing overhead is applied on the basis of direct labor cost. That means the rate for department A is going to be $600,000 manufacturing overheads divided by 200,000 of labor cost. Yes, we can have labor hours also, machine hours, but this question takes the labor cost as a driver. Mostly questions would involve direct labor or machine hours, labor hours or machine hours, but this is a unique question. 600 upon 2000, that means the rate is 3, or you can say 300% of the labor cost. What about this? Manufacturing overhead is 400,000, labor cost is $800,000. If you divide it, it is 0.5, or just you may say 50%, or you may say just 3 times or 0.5 times. What does it mean? An item that goes to department A, and if the department A incurs labor cost of $8,000, the manufacturing overhead is 3 times of the labor cost. 3 times of the labor cost, that is 24,000. The item goes to department B, incurs $12,000 labor cost, the overhead in this department is 0.5 times of the labor cost. 12,000 times 0.5, that is 6,000. Khalas takum. Add them up, you get your answer. So the rate here tells us that the overhead applied is 3 times or 300% of the labor cost. 0.5 here means 50% of the labor cost, or simply 3 and 0.5 and you got the answer. Add 25 plus 20 plus 24 plus 6 gives you $75,000. So this is the cost associated with the job 432. That makes B to be the correct option. Next question is related to budgeting. What is the budgeted production in pads for the month, for the fourth quarter? We have to draw up a production budget. For this we need sales first. Have we been given sales? We have not been given sales. Interesting. There is no sales and the production budget is already given. Look at this, is interesting. This is very interesting. Apparently it looks a very difficult question involving lots of computation. It's a very straightforward question, be alert. We needed production for the fourth quarter, and fourth quarter means we're talking about October, November and December. And I was looking for sales, but he has given you the budgeted production of the notepads for the next 4 months, September, October, November and December. I am concerned with these 3 months being the fourth quarter. What is the planned production for these 3 months or the fourth quarter? Just add them up and you will be seriously confused on the exam. That could it be that simple on the? Yes, it can be. Your examiner can dodge you this way, can create these sorts of distractions by hiding an easier question in verbosity, and you will get seriously confused that this can't be that simple. See, CM Printing Company produces paper notepads. 1 ream of paper will produce 25 notepads. Budgeted production of notepads for the next 4 months is as follows. This. The company wants to maintain monthly ending inventory of paper equal to 25% of the following month's production. On August 31st, these many reams of paper were in inventory. The cost of the paper is 4 per ream and the notepads sell for this much. What is the budgeted production in pads for the fourth quarter? 4 plus 7.5 plus 6 gives you a straightforward number, 17,500. It could be as simple as this if you are alert. And if you are in a state of anxiety, which you most likely be if you haven't prepared well, you will mess this question up. Next, here you need some computation. Same question. We have already read it. It says, what is the budgeted cost of paper to be purchased in September? I always recommend, whichever month is involved, take that month, 1 month immediately following this month, which is October, and 1 month immediately preceding, that is August. Right? This is the first thing. As per the question, it says the company wants to maintain monthly ending inventory of paper equal to 25% of the following month's production needs. Okay. It further says, this is the important piece of information, 1 ream of paper will produce 25 notepads. 1 ream of paper will produce 25 notepads. We purchase in reams, not in pads. Pads is what we make. So if you are talking about 5,000 pads in September, for this, how many reams will we purchase? How much paper will purchase? 1 ream of paper will produce 25 notepads, right? So that means if we want to produce 5,000 pads, 5,000 divided by 25, that will give you 200 reams of paper. For October, 400 upon 25, that will give you 160. We don't need November because we are interested in September, October and August. So your planned production for the month of September is 200. For October is 160. I hope you remember the format. Planned production plus desired closing stock minus opening stock. Our desired closing stock, as per the policy, your closing stock must be 25% of the next month's need. If you need 160 next month, 25% of this must be in the closing stock, that's 40. Minus opening stock. The closing stock of August is the opening stock of September. Look at this. On August 31st, 100 reams of paper were in inventory, which means that's the opening stock of September. So we need 200 for production, 40 is a desired closing stock, we need 240. If we need 240, of which 100 is already available, so effectively we need 140. That's our net need, because 240 we need, hundreds are already available, so we need 140. This is the purchase we need to make. Since the purchase is given in dollar terms, so we must multiply it with the price given. And notepads sell for 0.5 each, or is it no? On August 31st, prices, the cost of paper is 4 per ream. These are the ream, 140 reams multiplied by 4, and that don't tick B, that is the dollar amount. This is the number of reams. So 140 times 4, $560 is what we should expect to purchase. So this is the quantity we need to buy. This is the amount we will have to buy to carry on our production. So 560C is the answer. Okay, next question is a straightforward one. I hope you have studied your coefficient of correlation. Coefficient of correlation is range bound. It is greater than equal to -1, less than equal to +1. And you don't have to calculate the value of coefficient of correlation. It will be given to you. You just need to interpret. Values which are perfectly positively correlated will have +1 value of R, and the values items which are negatively correlated -1. Right? This is from section B. Let's say I have established R for my advertisement and my sales. They are possibly related. If you spend more on advertisement, your sales goes up, and it comes out to be 0.90, for example, which means a very strong positive correlation. Put more money on advertisement, your sales goes up. This is called coefficient of correlation. If I take the square of this number, which is basically 0.9 squared, 0.81, which is 81%, this is called coefficient of determination. What it tells me? It tells me the 81% of variation in sales is because of advertisement. There is such a strong relationship that if my sale changes, sale varies, or there is a variance in sales, 81% variance is because of advertisement. So spend more money on advertisement to make more money. So the correlation coefficient R describes the degree of relationship between two variables. It has this range, and it is 0.6. What proportion of the variation in the dependent variable, sales, can be explained by the variation in the independent variable, advertisement? Take the square. Take the square, express it in percentage, click A, go home. As simple as that. Okay, next question. Trans company had the following balances at December 31st, 2005. What exactly are we looking for? What amount should Trans report as cash and cash equivalents in December 31st balance sheet? Cash in money market account. Regarding other instruments, other items, let me tell you, we will call an item as cash equivalent if it fulfills two things. First, it has a maturity of less than 3 months, plus the investment is highly liquid, can be sold in exact known amounts of what will sell for. So it is less than 3 months of maturity, and it is highly liquid, and there is no price uncertainty. So there is no issue with cash or cash in money market account because they're highly liquid and known amounts are given. We have some T-bills which we purchased on 1st November and 1st December. We are standing at 31st of December 2005, which means these T-bills have 2 months of maturity, and these which we purchased December 1st will mature on 31st March. They have 3 months maturity. So this one fits the bill, but is it liquid? No. T-bills are not highly liquid, but not good enough that we can call them as a cash equivalent, because we can't sell them on exact amount. There are certain price concessions given to sell them. So remember, T-bills do not have price exactitude for the purpose of considering them as cash equivalents. So these two are. Trans policies to treat cash equivalents at highly liquid investment with a maturity of 3 months or less when purchased. What amount should Trans report as cash and cash equivalents? So these two 3575 will give you the total number we need. And what is it? 110. D is the answer. Next. This is the typical question on the exam, and you will see a few questions for sure, at least at least 2, projecting cash collections. So the question says how much cash we expect to receive in the month of September, and we have been given sales. So the right thing to do is to Turnbull company budgeted sales on account of 120,000 for the month of July, 211,000 for the month of August, and 198 for the month of September. This is the budgeted or planned sales. Collection experience indicates that 60% of the budgeted sales will be collected a month after the sale. What you sell in July, 60% is collected in August, and 36% will be collected the second month after sale, and 4% is bad debt or credit losses. So what you sell in July, 60% is received in August, 36% is collected in September. Question says how much you will collect in September. So this is where you want to collect your cash. What you sold in July, 60% is collected in August. Now you will collect 36% of the remaining amount. What you sold in August, 60% of this amount will be collected in the month of September. So 120's 36% and 211,000 60% gives you an error. I didn't calculate it properly. 120 times 0.36 plus 211,000 times 0.60 gives me 169,800. So the total collections in the month of September would be 36% of July sale and 60% of August sale, and it's a perfect match for your option C, right? Okay, so what? Okay, before we do this question, I think this relates to flexible budgeting. Please note, at the beginning of each quarter or each year, we make a budget called the static budget. A certain standard quantity at standard price. But after the period is over, a month, a quarter, or a year, we get actual results, which is basically actual quantity versus actual price. We should not compare these two because static budget may be for more or less, actuals that might be different. So what we do, we find a mid budget called the flexible budget, where we take the standard price from static budget and actual quantity from the actual results. This is what you call the flexible budget. Actual quantity multiplied by the standard price. This is called flexible budget. Now the question says, if an organization actually uses $60 of material per unit activity, okay, plans to use 55. This is the actual price. Plans to use 55 of the material per unit of activity. This is the standard price. Actual is 60. They want to set a tough standard. Standard price is 55. And it wants to produce 10,000 units of quantity. Actually makes 11,000 units. This is the standard quantity. This is the actual quantity. See, we have been given the actual price, actual quantity, standard price, standard quantity. If you take these two, you get static budget. If you take these two, you will get actual results. So the question says, what is the flexible budget amount? In which we will take the actual quantity, 11,000, and the standard price, which is 55. So 11 multiplied by 55 gives you 605,000. And what is the actual number? Actual quantity, we bought 11,000. Actual price was 60. This is the actual result. And what was the original static budget? Static budget was 55 here, and standard quantity was 10,000. See? So please compare these three well. So you know this is all the budgeting is all. Budgeting is based upon this structure. Static budget, flexible budget, and actual result. So right now we were supposed to find just the flexible budget, and that is not 605. Did I? Oh yes, 605. Yes, right. 11 plus, yes, 605. This is 660. So he has given you all the results. This is not the right answer. This is C is the correct option. Okay, next question 27. An example of supervised learning algorithm, machine learning, talking about the technology and analytics. So we don't know anything. What is algorithm? First we need to understand what is algorithm. Algorithm basically is a step-by-step set of instructions. When we want computer to do something, we first create an algorithm that how the computer will solve the problem. Certain step-by-step instructions for solving a problem or for doing a task. Those step-by-step instructions given to the machine, following these steps, a problem will be solved or a task will be performed. This is called algorithm. So an example of supervised algorithm, learning algorithm for the machine, computer systems, machine learning. Which of these? Clustering. Let us see what is clustering. Clustering is a grouping of similar data points with certain characteristics, like for example, individuals with income level of $100,000 per year or more. Income group between the range of $50,000 to $60,000. This is called clustering or grouping. Grouping of data with certain characteristics or features. So this is not clustering. We're talking about learning algorithm for learning. We want machines to learn something from certain. Visualization involves graphics. Structured query language, your relational database management system like Oracle. So structured query language, they are programming language which we use for managing and manipulating relational databases. Previously, when Oracle Financial wasn't introduced, the original version of Oracle used to be managed through SQL command language. We used to give command, like we want to print a report, we had to give command to the SQL, on the SQL to retrieve certain reports. So relational database management system, this is the language used to manipulate and extract data of your choice. So this is not what we are talking about. We are talking about supervised learning algorithm where we want machines to learn, and this is possible through simple regression. What is simple regression? The two variables may have a relationship like advertisement and sales, and we want our machine to learn a relationship between advertisement and sale based upon the past data and then predict the future, right? So simple linear regression is a learning model. It's an algorithm that if you take a certain input for X, a certain Y should occur, right? Certain units are produced, cost behaves and responds to that number of units produced, right? So the simple linear regression is a learning algorithm for machine learning where machine is given inputs in the form of X variable called the independent variable, and then based upon many past data points, machine will tell you what is going to be Y in these range of X values. Okay, next we have a company with competitive advantage. You have something unique, others don't. So options are very close. Pay special attention. A company with competitive advantage will usually have more loyal customers than its competitors. Having loyal customers doesn't mean you have a competitive advantage. Competitive advantage is invariably correlated with flus. Please keep this in mind in today's ruthless commercial world. Competitive advantage is all about money, profit. So maybe your customers are loyal because you are selling them at a very low price, mafi profit. This is not competitive advantage. Yes, charging high price to generate profit, that would mean. Competitive advantage invariably is linked to profitability. So being competitive, having competitive advantage means earning higher profit than your competitors. This is what you should link competitive advantage with. Generating more profit than your competitors is competitive advantage. More influence with members of the Congress than its competitors for political manipulation. There is a specific word used for it that is called, so that is lobbying. Lobbying is not a competitive advantage, will never be unless you make good deal of profit. And lower wage and salary cost than its competitors, that gives you cost advantage but not a competitive advantage to being more profitable. Eventually this is the ultimate correlation of competitive advantage and profitability. They are linked. Others can be the source, but we are not sure that it could help company to make more profits, right? So this is it. Eventually this is what we link competitive advantage with. Okay. The purpose of internal control is to guarantee or provide a guarantee that fraud will not occur. No system of internal control can provide you guarantee. This is incorrect. The purpose of internal control is to prevent errors and omissions. It does, but it will not always, not assurance that all errors and omissions are prevented. D. Purpose of internal control is to preserve the tone at the top. Tone at the top means people at the top, people at the helm of affairs, those who decide. So this in fact is the other way around. It's the result. Internal control system is the result of the tone at the top, is the result of the management's operating philosophy and operating style. Internal control is the reflection of how the top management perceives things, how they see. So this is totally in the opposite direction. Then what is the purpose of internal control? To help the company to achieve its objectives. The question says we need to calculate the budgeted sales commission for the month of November. So it's selling and administration budget. It says for the month of November, renewable paper products has budgeted sales of letter size paper. 40,000 cases were budgeted for letter size paper at a selling price of $20 each, and legal size paper at 10,000 cases at the rate of $25 each. Okay. Sales personnel receive a salary plus a 5% commission on all letter size paper. This is the commission percentage on letter size paper, and 8% commission on all legal size paper if the group meets its monthly legal size paper revenue quota of $300,000. So this is the budget given. This is for the target given for the legal size paper, and we have this much target for the letter size paper. Let us see what actually is the case. So for letter size paper we have 40 times 20. That means $800,000. And for this 10,000 times 20, $250. So this is the target. This is what we achieved. So clearly we did not achieve the target. So there is no commission for this domain, for this product. But if you just look at this, the target was 500,000, but we were able to achieve this much sales. So yes, we are entitled to claim commission on this item. So 800,000 times 5%, that will be 40,000. So this is the commission as per the information given. So that would make D to be the correct option. Legal size paper, the sale didn't meet the target, but for letter size paper, it did meet the sales target. So it is entitled to receive sales commission. It's a fairly straightforward question. If you read the information carefully, you will be able to manage it. What is the role of an accounting information system in a company's value chain? The AIS is used by management to determine which activities in the company's value chain are primary and which are support. This is absolutely wrong, rubbish. It's Porter value chain analysis, and he has segregated certain activities as primary and support. So this is totally incorrect. AIS adds value to the company's products and services. AIS is just a system for record keeping, accounting information system. How does it add value? No, it doesn't. The AIS is a support activity that makes it possible for the organization to perform its primary activities in the value chain. It is just a record keeping system for decision making, providing decision support information. So what is AIS basically? It provides information to enable the efficient and effective performance of company's value chain activities. That makes sense. It provides you the information on how we can use efficient and effective use of company's resources. Next. Outlet company makes and distributes beach equipment. Last year its sales were 15 million and net income was 1.5 million, and the assets used were $35 million. The return on investment, you immediately should recall the formula. Return on investment is equal to net income over assets deployed. Quite straightforward question. We don't need sales revenue. What we need is net income as a numerator, and we need assets as a denominator. So it's going to be 1.5 million as net income and 35 million as your denominator as assets. So just calculate the percentage. It's a fairly straightforward question. No twist in it whatsoever. So you will get some question like these, what you call the low hanging fruit. So it will be quite easier to score well on these questions. Make sure you read the information carefully. Now these are the challenging stuff. This is clearly a challenging question. If you look at the size of the question, it tells you that I am a challenge. You are required to find out the material mix variance, and I'm sure you would have got the formula sheet Material mix variance. We know the formula. Material mix variance, as per the sheet given to you, you first have to calculate the standard price of standard mix, standard price of actual mix, the difference between these two multiplied by the actual total quantity. What are they? Let us see. This is the formula for mix variance. Let us see the question all about. It says Green Grow Company produces lawn fertilizers. The standard cost and inputs for a 500-pound batch of fertilizers are below. Okay. Nitrogen, phosphorus, potassium and fillers in these quantities. These are the standard quantities we used and these are the standard rates. So this is basically the standard mix and this is the standard price. Nitrogen at this rate, phosphorus, potassium and filler. So multiplying the quantities with the prices gives you the standard cost. Okay. So what you should do, this is the cost of this 500 pounds of mixture. First you should find out the weighted average cost of the standard mix. How you do it? 469.14 divided by 500. This will give you the weighted average price of standard mix. Weighted average price of standard mix, for short I call it SPSM. Weighted average price of standard mix. These are the standard mix quantities and these are the standard prices. Total value divided by the quantity. If you do 469.14 over 500, it gives you 0.93828 dollar per pound. Okay, what happened? The beginning material inventory was 0. The quantities purchased and used during the current period are shown below. A total of 150 batches were produced during the current period. We purchased these quantities of these 4 items. We are not interested in what was purchased. We want to see what was used in these 150 batches. 18,400 nitrogen was used, phosphorus this much, potassium this much. This is the actual mix. Actual mix of these 4 components: nitrogen, phosphorus, potassium and filler. And you don't see the actual price here. The standard price of standard mix, standard price of actual mix per pound basis. So you have to take the standard price here. What is the standard price? 0.25, 17.984, 2.44 and 0.49. This is the actual mix of these 4 components. This is the standard price. In material mix and material yield variance, you never use the actual price. Standard price for standard mix, standard price of actual mix. This is the weighted average price of standard mix. This is the weighted average price of actual mix. You multiply these all, 18,400 times 0.25, 1,500 times 17.984, all these multiplication will give you a total value of 71,152.5. This is the total value for how many pounds? 75,000. So $71,152.5 for 75,000 pounds of these 4 components. It gives you 0.9487 per pound. This is the weighted average price of the actual mix and I call it SPAM as per the formula sheet shared with you. Okay. So this is the standard price of actual mix, standard price, actual mix and standard mix. This is what you use as a formula, which is on the sheet I shared with you. So the standard price of standard mix was supposed to be 0.93828 per pound, but we changed the composition of these materials, resulting in our average rate went up. Our average rate went up to 0.9487 multiplied by the actual total quantity. You use actual total quantity of 75,000. So since your mix was bad, this bad mix has resulted in a higher average price per pound. Standard average price, weighted average price was So your mix is adverse. It will give you a negative number, 0.93828 less 0.9487. It's clearly a negative number. Multiplied by 75,000, you get negative 781.50. And a negative number means an adverse variance. So that makes C to be the correct option. Right? So weighted average price of standard mix, weighted average price of actual mix, and you always use the standard price for mix and yield formula. So that is the answer. Same question, but this time you have to find out the material yield variance. No big deal. We know the formula. For yield variance, you take what the standard total quantity should have been versus what was the actual total quantity used multiplied by the weighted average price of standard mix. Actual total quantity used was 75,000 pounds. Standard total quantity, you produced 150 batches. As per the standard, each batch is supposed to use 500 pounds. Your 150 batches should have consumed 150 times 500, 75,000 pounds. So 75,000 pounds of the material should have been used, and 75,000 of the material was actually used, multiplied by the weighted average price of standard mix, which is 0.93828. Since these two numbers are the same, so what you're going to get is a nice 0. There is no yield variance, so that makes C to be the correct option. C is the answer. Right? So this is a good typical question of mix and yield variances. You need to know your formula, you need to know what inputs you are supposed to take, and there you go. Okay, so next question again is a bit challenging question. There are total of 4 variances related to overheads. First, fixed and variable. Fixed has 2 variances. First is the fixed spending and fixed production volume variance, and variable has 2 variances, variable efficiency and variable spending variance. When it says a two-way variance, he is combining these 3 variances together into a single variance. Please note, fixed spending, variable efficiency and variable spending. Collectively, these 3 variances are called the budget or controllable variance. Production volume variance is a separate variance, cannot be added anywhere. Whereas fixed spending, variable efficiency, let me write it properly, variable efficiency and variable spending, these 3 variances collectively are called the budget variance or controllable budget variance. So you need to know their formulas. Fixed spending variance is simply the difference between what was budgeted versus what was the fixed cost actual. Variable efficiency variance, as per the sheet that has been shared with you, efficiency variance is how much units of hours or machine hours you are supposed to take, and what was the actual quantity of the labor or machine hours you used multiplied by the variable overhead absorption rate. And the spending variance is actual quantity of hours used multiplied by the variable overhead rate minus actual variable cost. Combining these 3 involves a little math. I'm going to just write the final simplification. You should do it yourself. The final addition of these 3 variances gives you, let me clean this up. Final result of these all variances combined is equal to standard quantity of machine hour or labor hour, whatever it is, multiplied by the variable overhead absorption rate plus fixed budgeting. It's a simple math. Do it. Write those formulas down, add them up, cross some items which can be cut. This is what you will end up with. Minus actual total manufacturing overhead, which is basically sum of the variable overhead actual plus fixed actual. These two collectively means actual total manufacturing overhead. We need to find this variance, ladies and gentlemen, called the budget variance or the controllable budget variance, which is sum of 3 variances: variable spending, fixed spending, and variable efficiency. Let's read the question. It says Universal Company uses a standard cost system and applies overhead on the basis of direct labor hours. That is the application base, direct labor hours. Fine. Universal prepared the following budget at normal capacity for the month of January. Direct labor hours 24,000 as per the budget. Okay. Variable factory overhead 48,000. Fixed factory overhead 108 and total factory overhead 6.5. Now this is interesting. We need variable overhead absorption rate. whereas we have been given a combined composite overhead rate. 6.5 is a combined rate of variable and fixed. So what we should do, at least we can make some sense out of it. Take the fixed overhead, budgeted fixed overhead, divided by the budgeted activity. 108 upon 24,000 gives you 4.5. It means the fixed overhead absorption rate is 4.5. Out of 6.5, $4.5 per labor hour is the fixed overhead absorption rate, fixed overhead recovery rate, fixed overhead allocation rates. Then the balance, $2 must be the variable overhead absorption rate. This was the first element we needed. Tuck. Variable overhead absorption rate. Next we need how many hours, labor hours we should have worked. This is called the standard quantity of labor hours we should have worked. Direct labor hours worked actual. We don't need the actual labor hours. We need the labor hours that we should have used based upon our standards. Standard direct labor hour allowed for capacity, and this is what you call the standard hours allowed for the actual output produced, 21,000. What is the fixed budget? This is it. 108 is the fixed budget. What is the actual total manufacturing overhead? This is right here. If you know your formula, you can never get any variances questions wrong. So if I simplify, it is 42,000 plus 108,000 versus 147,000. Adding these two added items gives you 150. This is what we thought our spending will be as per the flexible or controllable budget. But the actual overhead spending was 147. We have been 3,000 positive. That means the overall budget variance or controllable budget variance is 3,000 favorable. That makes B to be the correct option. Please learn the formulas of variances by heart and learn how to extract the relevant information to solve the question. Which of the following is not a preventive control? Mind the word not. Following payment, all invoices are marked paid by the treasury so that these invoices are not resubmitted for payment. Absolutely a fantastic preventive control. Once the payments have been made to suppliers on certain invoices and goods received, all the documents with a bunch in the voucher must be crossed, stamped or defaced so that they cannot be resubmitted. It's a good preventive control. The account receivable subsidiary ledger is reconciled against the general ledger accounts. Account receivable subsidiary ledger contains all the breakdown of your thousands of customers, and a single summary account is available in general ledger called the account receivable control account or total debtor ledger account. Such a reconciliation is done to identify some problems. Reconciliation is always a detective control. Bank reconciliation, detective control. Supplier reconciliation, detective control. Reconciliation of your inventory in the physical warehouse versus the inventory records. Warehouse control maintains the custody of your material. Inventory control maintains records. Comparing these two is also a detective control. So this is not a preventive control, it's a detective control. What about C? Customer numbers are verified by the computer before a sales order is accepted to ensure sale order is from an established company. We do not accept any sale order unless it is from the customer with whom we have a credit agreement. Only those customers' purchase orders will be entertained who exist in our master file of accounts receivable. So it's a good preventive control. Duties are segregated to institute what you call a CAR. Custody, authorization, record keeping and reconciliation must be segregated. Like for example, Afzal has cash. Hasib will have the authorization to conduct cash transactions. Record keeping is given to Ishan, and a person who is totally unrelated like Sajawal who doesn't bother, he is the one who will reconcile. So custody, authorization, record keeping and reconciliation must be segregated. This is called segregation of duties. So duties are segregated to make it difficult for an employee to both perpetrate and conceal a fraud. If Afzal has everything, custody of cash, authorization, record keeping, reconciliation also, he can play with cash. But if we divide responsibility this way, it will be difficult for a single person to commit a fraud and hide it, because someone during reconciliation, record keeping will catch. So it is segregation of duties is a fantastic preventive control. So which of these is not a preventive control? is reconciliation, which basically is a detective control. So we got the answer, it's B. Okay, it's a good one as well. It says a company currently experiences 330 errors in its processing each month. Performance projections for a new machine are expected below. There is 20% probability that errors will be 150, 30% probability that the errors will be 200, 40% errors will be 250, 10% probability that the errors will be 280. So we can neither take the higher end nor the lower. What we do in this case, we take the expected value, which is using probabilities and as weights and multiplying them with the error rate. So expected values of errors is 20 times 150 plus 30 times 200, 40 times 250, 10% times 280. Just EV, I'm sure you know how to calculate. It will be 218. So your existing system is generating 330 errors a month. A new machine will lower the error to 218. Thereby, what is the difference? How much reduction in the errors? 112. Given that each error cost the company $125 to rectify, this new machine will lower your errors from 330 to 218, thereby saving you 112. What are the long-term monthly cost savings that will arise from the purchase of the new machine? This is the saving that we have been able to generate because of new machine. So multiplying 112 with 125 gives you a total saving of $14,000. That is C. Next, according to COBIT, data governance is the responsibility of whom? Be very careful. Data governance is the responsibility of those who are charged with governance. Who are charged with governance? Board of Directors. They are primarily responsible for governance. So hence they are responsible for data governance under the COBIT 2019. Look no further. This is your answer. Okay, this is a good question. What we need: how many pounds of direct material should be budgeted for purchase? Direct material purchase budget. A company has budgeted sales of 24,000 units. This is the sales, okay, for the forthcoming 6-month period. It takes 4 pounds of direct material to make one finished unit. Given the following, we have the opening and closing stock of finished goods, opening and closing of direct material. How many pounds of direct material should be purchased? You cannot directly draw up the purchase budget without first writing up the sales budget. From sales budget, we draw our production budget. From production budget, we can draw up our purchase budget. Sales is already given. So how do we drive production budget from sales budget? We know this. We take the planned sales or budgeted sales, 24,000. To this we add our desired closing stock of finished goods. Desired closing stock of finished goods is 48,000. Oh no, sorry, this is material. It is 12. And from this we deduct the opening stock of finished goods. Deduct opening stock of finished goods, 14,000. So this will give you 22,000. This is the production budget. This will be the input to your direct material purchase budget. So it says that each unit requires 4 pounds. If you are planning to produce 22,000 finished units, then the material needed for production, 22 times 4, we need 8,800 pounds of material. Or is it 22,000? 22,000 times 4, it is 88,000. We need 88,000 pounds of material for production. Our desired closing stock of raw material, I'm sure you know the format. Desired closing stock of raw material is 48. And our opening stock already given is 44,000. Just net these up. Remember, first you need the sales budget. From sales budget, we write up our production budget. Only then we can draw our direct material purchase budget. So from sales to production, from production to direct material purchase. 88 plus 48 less 44 gives you 92,000 pounds, and that is D. Follow the instructions carefully. You will always get the right option. Okay. So what do we have in this question? Apparently a big question. It says, what was the total direct labor variance? Always read the requirement first so you know what you are supposed to do. Please remember, total direct labor variance is sum of two variances, labor efficiency variance plus labor rate variance. Rate variance sometimes is also called labor price variance. Labor efficiency variance is also sometimes called labor quantity variance or labor usage variance. These are alternative terms. Labor quantity, labor usage, labor efficiency are all the same. Labor rate and labor price are the same. So, what is the total direct labor variance? This is it. What have we been given? Look at this interesting aspect. Unfavorable direct labor rate variance. Direct here. Favorable direct labor efficiency variance. See? Once you, at least I knew what I was supposed to look at, but once you read the questions requirement, you know what you, let's say you know that you need the total direct labor variance. Material is irrelevant, units are irrelevant, so material is irrelevant, material price is irrelevant. Eventually you will end up with these two numbers. Right? So that's why reading the requirement is important so that you can focus your energies in the right direction. Unfavorable labor rate variance, negative 7,000, because negative as per my formula sheets means adverse. Efficiency 4,000 positive. If you add these up, you still get 3,000 negative. That means the total direct labor variance is still unfavorable. D is the answer. Right? So, know your formula, read the requirement carefully, you will get your things right. This is another part of the question. What is the actual price per piece of direct material? We need to find the actual price. That is the question. What we have been given? We have been given the material price variance, which is right here. Material price variance is favorable, 32,500. Okay. What else? Labor unfavorable total direct labor material, total direct material. Okay, we have been given the total direct material variance. We will apply the same idea. We know total direct material variance is equal to material price variance plus material efficiency variance. Remember, material efficiency, material usage, material quantity variance, they are all the same. So we have been given the total material variance, that is 27,500 unfavorable, 27. Let me erase this and write it cleanly. Total material variance is adverse, 27,500. Material price variance 32,500 favorable. This will give me the material efficiency variance. Right? So just make this as the subject. Material efficiency variance is negative 27,500. Further negative 32,500. So some massive adverse variance of $60,000 negative. This is the starting point. We know efficiency variance is the standard quantity of material we should have used versus the actual quantity of material we actually used multiplied by the standard price. So this is negative $60,000. Do we have the standard quantity? Yes, it says standard material is 10 pieces at the rate of 4 each. This is the standard price. This is the standard quantity per piece. Okay. All right. Let us plug in the numbers. It says we produce 5,000 units. If you produce 5,000 units, our standards tell us that each unit should take 10 units, 10 pieces of raw material. If 5,000 units have been produced, you should have used 5,000 times 10. You should have used 50,000 pieces in producing 5,000 finished units. How many did you actually use? We don't know that. Let's put it as AQ. What was the standard price per piece of raw material for? 60,000. So you're going to just do this basic arithmetic. 60,000 divided by 4. That is negative 15,000. 50,000 minus AQ. AQ is equal to 50 plus 15. Actual quantity of raw material used is 65. Whereas you should have used 50. So this gives you actual quantity. What are we required to find out? We are required to find out the actual price per piece. We don't have it yet, but we can find. Let us take, let me first erase this so that we can use the right formula. We know the material price variance is equal to the standard price minus actual price multiplied by the actual quantity, which we have just calculated, put it there. So it says material price variance is favorable, 32,500. Standard price is $4 per piece. Actual price, which we are supposed to find, is AP. Actual quantity used is 65,000. This 65,000 will become denominator of this number, so it's going to be 32,500 over 65,000 is equal to 4 minus AP. If you simplify, this is 0.5. So 0.5 is equal to 4 minus AP. This means AP is equal to 4 minus 0.5. That means 3.5, which means the actual price is 3.5, whereas the standard price was 4. We bought the goods for a lower price. Actual price was higher. That's why there is a massive favorable material price variance, which is 32,500. So this is the actual price, and B is your answer. So B, very numerate. Make sure you're doing the right working, know your formulas correctly, and you are on your way to qualify as a CMA. Budgeted production. Okay, if you are looking for production, we need to have sales budget. Do we have? Yes, we do. Sales budget. Do we have the policy for closing stock? Yes. Each month's closing stock of finished goods must be 15% of next month's sales. See, the requirement will tell you what you should be looking for. Sales budget, policy for closing stock, and something else. So, since we need for Jan, I told you if you are looking for a certain month, take the month immediately following and take the month immediately preceding. This will make things easier. Sales budget, add desired closing stock, deduct opening stock. That's the format, and our focus is only on the month of January. So it says that December sale isn't given. January sales is 8,500. February sale is 8,100. As per the policy, COBCO has policy of keeping finished goods stock at the end of each month equal to 15% of the next month's sales. My closing stock in Jan must be 15% of Feb's sales. It comes out to be 1215. Further, in order to avoid potential stock outs of the finished goods, a minimum 1200 units must be kept at all times in the warehouse. So it means closing stock has to be 1200 units. At the beginning of January, the inventory of finished goods is expected to be 1200 units. Means the starting of Jan, the opening stock is expected to be 1200. Sales budget, desired closing stock, expected opening stock in Jan, net these off, you get 8515, and that is what you are supposed to produce, and that is your answer. Next, same question, but you need something else here. It says, what quantity of finished goods inventory is budgeted to be on hand at the end of the first quarter? This is your first quarter, Jan, Feb and March. So what should be the closing stock of March? Let's say we're talking about March. Closing stock of March must be 15% of expected sales in April. If you take 15% of April sale, it's going to be 1170. It should not be the answer, even it is given as D, because the question explicitly says our minimum stock must be 1200 units at all times in the warehouse. So despite 15% of April is 1170, but our closing stock should be at least 1200. So ignore this number, go for C, and as per the policy, C is the right answer. Okay. Now, this is a big question. Please read this up. Big question, and the suggested approach is to look for the requirement. The projected ending cash balance for February. Right, so it means we have been given the detail for Jan, Feb and March, sale, expenses and all that. And we have also been given the opening cash at the start of Jan, opening AR, opening accounts payable. The right approach to do this question is to make a consolidated cash account for Jan and Feb and plug in whatever you can. We already have an opening cash balance of $200,000. These account receivables at the start of January 1st will surely have been collected within Jan Feb, whole of it. This 400,000 accounts payable at the start of the year, January 1st, will surely have been paid during Jan-Feb. So these three numbers have been taken care of. Opening balance of cash, AR collected from the opening balance, and AP paid from the opening balance. Now let's move on to the question further. Group company's management team is preparing a cash budget for the coming quarter. The following budgeted information is under review. Revenue is given for all 3 months, inventory purchases and other expenses. Good. The company expects to collect 40% of its monthly sales in the month of sale, 60% in the following month. Immediately apply this concept here. Whatever you sold in January, 40% is collected within Jan, 60% in Feb. It means the whole of it has been collected within Jan-Feb. A total of 700 has been collected for Jan-Feb sale. In fact, for Jan sales. 40% within Jan, 60% in Feb. What you sold in Feb, 800,000. You will only collect 40% of this amount. 60% will come in March. We are considering Jan-Feb only. So 800,000, 40%, that is 320. So this is related to Feb sale. Only 40% has been collected. What about the expenses? It says in 50% of inventory purchases are paid in the month of purchase and 50% in the following month. 350 goods bought in Jan, half paid in Jan, half in Feb. That means this 350 has been fully paid. 425, half to be paid in Feb, half in March, which means out of this 2.5 has been paid. Regarding expenses, it says payment of all other expenses are made in the month incurred. 150 expense in Jan is paid within Jan. 175 expense in Feb is paid within Feb because we are making a combined account of Jan-Feb. You have everything you need. Opening balance, AR, January sales, Feb sales, opening AP, that is the inventory purchases for the month of Jan-Feb. Deducting all these, everything is in order. The closing balance comes out to be 232,500. And this is a perfect match for option A. If the question asks, what is the projected change in cash balance? Not the closing cash balance, change in cash balance. In that case, simply ignore this opening balance. Just take all the inflows and all the outflows. Inflows minus outflows is the projected change. But only if the question says projected change in cash balance. But here, the question explicitly asked, what is the ending cash balance? So for this, you have to consider the opening balance as well, right? So this is done, a big question, but if you know you're working, you know how to take which number, put it where. I'm sure you can do it. A good question indeed. It says what is needed. Which of the above outcomes will Smith Howard most likely experience from the change in its approach to budgeting preparation? Some changes we are expecting. Why? Because Smith and Howard Corporation recently changed its budgeting preparation from participative to authoritarian. First, management used to set up the budget. Now the top management, top guys in the boardroom, they are the one who decide the budget. Consider the 5 possible outcomes. So since the budget is being prepared at the top, people sitting at the top, the efforts made by mid-level management to achieve the budget goals will likely increase. Efforts will decrease because the mid-level management were not involved in the decision-making process. They were not involved in the budget setting. They are unhappy. They are resentful. They are angry. Hence, their efforts to achieve the budget goals will decrease, not increase. It is incorrect. Since the top management, just 2 to 3 guys are sitting, the amount of slack present in the resulting operation budget will decrease. Yes, since these 2 to 3 guys at the top, they will try to put a very stiff and stringent budget, and they will try to remove all the budgetary slack. What is budgetary slack? A deliberate, intentional overestimation of expenses and underestimation of revenues, just to make your targets look easier. So yes, these people will remove all the possible slack. This will happen. The resulting budgets will have more of a tendency to reflect overall company goals rather than individual divisions and departmental goals. That is true also. Because when the top management will set the budget, they will take things more holistically. They will take the overall goal of the company in mind, whereas when the budget is set by the bottom-up approach, individual managers tend to take decisions that favor them. So this will also happen. So 2 will happen, 3 will happen. Let's see what it says in 4th. The company will probably experience a decrease in the cost associated with budgeting development. Absolutely. Bottom-up budget is a costly activity. All managers should sit together to make the budget, whereas in top-down approach, only 2 to 3 guys sit. Maybe they can make the budget in 1 hour. Halas, take the budget, go home. So this is true. The cost to prepare the budget will reduce because only few people will be involved. Fourth, the number of budget iterations throughout the organizational structure will increase. This is wrong. In participative budgeting, the budgeting process has many revisions till it is finally approved. But here the top people, they will just make one budget and everyone must follow. So this is again not correct because iterations will, or revisions, iterations mean budget revisions. Budget revisions will decrease because just few people are there. So it means what will happen is 2, 3 and 4. That makes D to be the correct option. Okay, next. The standard direct material cost per unit for product is calculated as follows. 10.5 liters at 2.5 per liter. This is the standard price. This is the standard quantity. Last month, the actual price paid for 12,000 liters of material used was 4% above the standard. If standard is 2.5, a 4% higher number, just add 4% to 2.5 within 2.5, so it's going to be 2.6. This is the actual price AP, which is 4% higher than the standard price. And the direct material usage variance was 1850. Remember, material usage or material efficiency or quantity variance is equal to standard quantity you should have used versus actual quantity you actually used multiplied by the standard rate. It is favorable, fine. No inventory of material was held. What are we required to find out? We are required to first find out the material price variance. Material price variance is equal to the standard price versus actual price multiplied with actual quantity purchased. Standard price is given as 2.5. Actual price is 4% higher, 2.6. And actual quantity purchased is 12,000 liters. A fairly straightforward question. And we didn't have to use the usage variance. So 2.5 less 2.6, negative 0.1 times 12,000 is negative 1200. And negative means adverse. So this clearly makes C to be the correct option. Same question, but this time we need the actual production. Let us go back because there we have all the working, then we will match our answer. Remember, we need the actual production, that is the AQ. AQ is required. Let us use this. Material efficiency variance has been given as 1815 favorable, so it's going to be a plus 1815 is equal to standard quantity. Do we have the standard quantity? No. Do we have the actual quantity? Yes. 12,000 liters of material were used. So this is the actual quantity of material used. Multiplied by the standard price. What is the standard price? 2.5. So if you solve this, 2.5 will become a part of denominator. If you divide 1815 with 2.5, you get 726. 726 SQ minus 12,000. So if you solve this for SQ standard quantity is 12,726. We don't need standard quantity, we need the actual price or something like actual production, how many units were produced. So we have got our standard quantity that should have been used, standard quantity that should have been used. It says that 10.5 liters are used for a single product. 10.5 is the standard quantity allowed for a single product. So if you use 12,726 as per the standard rate divided by 10.5, please note this is the quantity that you should have used. And each unit takes a standard quantity of 10.5. If this is what you should have used, each unit taking 10.5, how many units of output did you produce? You produced 12,726 upon 10.5, you produced 12. This was the actual output and that makes A to be the correct option. Just follow the formulas closely, you will always get the right option. What is budgetary slack? We just discussed it a little while ago. Budgetary slack is a deliberate overestimation of expenses. and underestimation of revenue so as to make your targets look easier. Budgetary slack can be best described as the planned overestimation of budgetary expenses. Yes, that's true. Look no further. This is true. Deliberate overestimation of expenses, the planned underestimation of budget expenses. Why would you underestimate? Wrong. I think straightforward, look no further. A is a very clear answer. Next question. What are we required to do? Units of material used to produce November output. Units of material actually used. We are looking for the actual quantity. Let us read the question. The main requirement is AQ. Cancom uses standard costing system in the manufacture of its single product. 35,000 units of raw material in inventory were purchased at this price. If this was the units bought, this is the price paid. Divide 105 with 35,000. You will get the actual price paid. 105 upon 35. The actual price paid is $3. It further says 2 units of raw material are required to produce 1 unit of final product. This is the standard quantity allowed for a single unit of output. In November, the company produced 12,000 units of product. This is the actual quantity produced. The standard cost for material allowed for the output was 60,000. Standard says that you should have used $60,000 worth of material. Please do not forget, if $60,000 is what you should have used in producing 12,000 units, that means each unit should have used 60,000 upon 12. 60,000 upon 12 means $5. Each finished good costs $5. But don't forget, each finished goods takes 2 raw materials inputs. Since we need on raw material point of view, material use, so that's why we will further divide 5 with 2 in order to find the standard price for our material use. This is the actual price of material input. This is the standard price of material. This was important. And it says there is unfavorable efficiency or quantity variance. This is the starting point. Labor efficiency variance is equal to how much material you should have used versus how much material you actually used multiplied by the standard price of material. Efficiency variance is 2500 adverse. Standard quantity that you should have used, you produced 12,000 units of finished output. Each should use 2 units of raw material. 12 times 2. You should have used 24,000 components. You should have used 24,000 components. What was the actual quantity of components used? That's what we are required to find. Multiplied by the standard price of material, which we calculated as 2.5. That's it. Negative 2500 upon 2.5 gives you negative 100. Or sorry, negative 1000. 24,000 minus AQ. Bring AQ to this side. Take 1000 there. It is going to be 25,000 units. This is the actual quantity you use. You should have used 24 as per the standard allowed. 12 times 2. But you actually used 25,000. That's why your material actually was used more than the standard allowed. D is the answer. A corporation declared dividends. There are 3 types of dividends: stock dividends, cash dividend, and property dividend. There is another type of dividend which is a very dangerous dividend. It's given at the end when the company is closed, called the liquidating dividends. The question says a corporation declared a dividend, a portion of which was liquidating. How does this declaration affect additional paid in capital and retained earning? Normally, whenever we pay a dividend, it is paid out of retained earning, whether it's a stock dividend, cash dividend, or a property dividend. But liquidated dividend, it is paid out of additional paid in capital. Let's say we paid a total dividend of let's say $60,000. Of this, 15,000 represented the distribution of profit, and remaining 45,000 represented liquidating dividend. So what we do with it? We debit retained earning with 15,000 distribution of profit. Remaining 45,000, which is the liquidating dividend, it is charged against the additional paid in capital, and we credit the bank account with 60,000. So what it means, since partly profit, partly liquidating, so that means retained earning will be reduced and your additional paid in capital. So the question says, how does this declaration affect additional paid in capital and retained earning? They will both decrease, because additional paid in capital because of liquidating dividends, and your retained earning because of your regular profit dividends, the dividend are paid out of profit. So that will make D to be the correct option. Next, which of the following is not a component of governance system over information technology according to COBIT? Please recall, you would have done it in your section E. These are the components of internal control system: control procedure, risk assessment, information communication, monitoring, and control environment. So this risk assessment, it's a part of COSO internal control framework, not COBIT. This is what it wanted. Which of the following is not a component of governance system over information and technology over COBIT 2019? COBIT 2019 is a totally different system. It has nothing to do with COSO model. So risk assessment is a part of components in COSO internal control framework. Rest of these three, processes, organizational structure, people skills and competencies, these are part of the governance systems under COBIT 2019. Please read the theory related to section E and F thoroughly from Becker textbook, should be sufficient to give you reasonable coverage of your syllabus. Which of the following is related to cash provided to operating activities? That's what we need. Cash from operations. Cash received from customers, operating inflow. Rent received, operating inflow. Cash paid to suppliers and employees, operating outflow. Tax paid, operating outflow. Cash dividends, yes, it's a financing outflow. Since we are only required to consider the operating cash inflows and outflows, so combining these all, 870 plus 10 less 510 less 110 gives you 260, which is B. Correct. Next, to avoid potential errors and irregularities, a well-designed system of internal accounting control in the accounts payable area should include segregation of which of the following functions from each other? Check signing, it is done by Treasury, and cancellation of payment documents, it is also done by Treasury. All the payment vouchers are crossed by Treasury. Check signing is also with Treasury, so this is perfectly fine. There is nothing wrong with it. Vendor invoices verification, it is with procurement. Merchandise ordering, it is also with procurement. So these two jobs are done by purchasing departments. Perfectly fine. There is nothing wrong with A, both are done by Treasury. Nothing wrong with B, both are done by the purchasing department. Look at this. Cash disbursements and vendor invoice verification. You hold cash, which is an asset. At the same time, you verify vendor. Maybe you verify your own relatives for payment purposes. This is inappropriate. This shouldn't happen. These are incompatible functions, should not be given. You don't give cash to accounts payable. Very risky. Physical handling of merchandise received. This is done by warehouse control, the department that has physical custody of the material. And preparation of good receiving note, this is also done by warehouse control that has the physical control over goods. So these two are compatible functions, but C clearly are the combination of incompatible duties, should be given by two different individuals. Okay, it says based on information, the actual number of direct labor hours used, actual quantity of labor hours, that is the ultimate requirement. Let us see and read the question carefully. Lean manufacturing uses a standard cost system with the overhead applied based on the direct labor hours. The manufacturing budget for the production of 5,000 units for the month of May included the following. 5,000 units will require 10,000 hours at the rate of 15 each. This is the standard price we pay to our workers. And for 5,000 units, 10,000 labor hours are required. That means our standard quantity of labor hour is 2. Each unit takes 2 labor hours. 5,000 will take 5,000 times 2, 10,000. Variable overhead, fixed overhead, fine. During May, 6,000 units were produced. Okay. And the direct labor efficiency variance was 1,500 unfavorable. Labor efficiency variance. Standard quantity of labor hours you should have used versus the actual quantity of labor hours multiplied by the standard price of labor. 1,500 unfavorable, negative. Standard quantity, you produce 6,000 units. Our standard tell us that each unit should take 2 labor hours, which means you should have used 12,000 labor hours. What was the actual number of direct labor hours? This is exactly what we are looking for. And standard price we pay to our worker is $15 per labor hour. Put this 15 here. 15 here will become part of the denominator. 1500 upon 15, negative 100. So 12,000 minus actual quantity, just rearrange the equation. AQ is equal to 12,000 plus 100 gives you 12,100. Actual quantity, the hours used is 12,100D. Use your formulas carefully, extract the information, and you will always get the right answer. Perma Corporation's management has determined that the company's required rate of return on the new project is 18%. Required rate of return is 8%. R. The Diddle division, a highly profitable division, has current return on its investment 13%. The Diddle division manager is considering a new project that would involve manufacturing frizzles, some product. The project is expected to require an investment of $1 million and to have an annual return on investment of 10%. This much investment is needed. Return on investment is 10%. What is the project's residual income? Interesting. This question involves both. Residual income is the operating profit minus imputed rate times the investment or assets. We have nothing except this 8%. We don't have operating profit. We do have assets. What about ROI? ROI is the operating profit. Ideally, you can take net income, but ideally you should use operating profit divided by the assets or investment. It says ROI is 10%. Operating profit, that's what we can find out by plugging the number. Investment is 1 million, which means your operating profit will be 1 million's 10%, $100,000. This was the input to this. Operating profit $100,000, required rate of return 8%, investment 1 million. So $100,000 is the operating profit, 8% of 1 million is 80,000. So your residual income is just 20,000. Know your formulas, learn how to apply them, and you will always get the right answer. Learn the formulas. Next. Baconia Company has established the following support cost pools and activity consumption cost driver for October 20X7. We have 3 cost pools. Purchase orders will have a cost pool of 50,000 and driver 100 orders. Machine setups, total cost of 120,000 for 200 setups. Electricity consumption will be $30,000 for 100,000 kilowatt hour. The first step you should do is to calculate the rate. 50,000 upon 100 orders gives you $500 per order. This is the rate for this cost pool. 120,000 over 200 will give you $600 per setup. And 30,000 upon 100,000 kilowatts hour gives you $0.3 per kilowatt hour. We have calculated the rates. Now, the following information pertains to the actual consumption of activities for 2 representative job completing during October. What is the total support cost assigned to job W1 using ABC? Job W1, the purchase order, the number of purchase order for W1 was 20. Each order cost us 500. Job W1 required 40 setups. Each setup cost us 600. And this job required 1000 kilowatt hours. The cost for each kilowatt hour is 0.3. So 500 times 20 plus 600 times 40, 0.3 times 1000 gives you a total of 34,300 as the total cost, and that is A. The next question is on the same data, but this time we need something different. This time we need what is the support cost per unit produced for W2. So what you will do here, same thing, 30 multiplied by 500, 40 multiplied by 600, 40 setups and $600 per setup, 2000 kilowatt hours. Each kilowatt hour cost us 0.3. If you multiply 30 into 500, 40 into 600 plus 2000 to 0.3, the total comes out to be 39,600. This is the total cost for job W2. Since there are 4,000 units in job W2, so on per unit basis is going to be 39,600 upon 4,000, 9.9. Straightforward. Just do the right computation and get the right answer. Now, this is an interesting question. Moss Company has determined its December 31st 2005 inventory on LIFO basis. Please remember, LIFO is only permissible under the US GAAP. And for LIFO, we have a different rule for the subsequent measurement of inventory. For LIFO and retail method, we use an LCM rule. What is LCM rule? You take cost at one end and you take the designated market price at the other end. Designated market price, which could be among these three numbers: NRV, NRV minus normal profit margin, and replacement cost. This method called LCM rule is only applicable on LIFO and retail method and only under the US GAAP. It says take your cost on one side. Let's read the question. Moss Company has determined its December 31st 2005 inventory on LIFO basis, clearly GAAP based financial statements, and the cost under LIFO basis is $400,000. Information pertaining to that inventory follows. Estimated selling price is 408. Estimated cost of disposal 20, 408 less 20, that gives you 388. This is the NRV which will be put here. NRV 388 less 60,000, which is the normal profit margin, it comes out to be 328. And the current replacement cost is 360. US GAAP says take your cost on one end and the middle number of these three on the other end. If you just look at this, which is going to be the middle number, 328 is too low, 388 is too high. We need to take the mid number. This is the mid number. 328 is too low, 388 is too high, so 360 is the mid number. Compare your cost with the mid number. This mid number is called the designated market price. Compare your cost with the mid number. If the mid number is lower, this becomes the new basis. If cost is lower, then you keep the cost as is. Since our designated market price, which happens to be replacement cost in this case, is lower than the cost, so the valuation will be 360. 40,000 loss would be booked and it is irreversible under the US GAAP. Moss record losses that results from applying the lower of cost or market value LCM rule at December 31st 2005. What would be the net carrying value of the Moss inventory? 360. C is the answer. Now let's say this question involves either weighted average method of inventory, specific identification method of inventory, or FIFO. In these three methods, ladies and gentlemen, US GAAP and IFRS, they are on the same page. They are on the same page. And what is the same page? Under the IFRS, US GAAP, under any of these three methods, you take cost on one side and you just take the NRV on the other side. Khalas, nothing, just NRV. Cost here is $400,000 and NRV is 388. So under the IFRS or US GAAP, if inventory valuation was weighted average or moving average, specific identification or FIFO, you take cost and NRV, whichever is lower is considered as the basis for valuation. So this was important question. So since we were required to use US GAAP, why US GAAP? Because LIFO is only permitted under the US GAAP. And that's why 360 is the answer. Next, which of the following is not part of the control environment of a publicly traded company? Not the structure of the organization and its reporting processes. It is a part of control environment. The manner in which the authority and responsibilities are assigned from top to bottom, it is control environment, component of control environment. The policies regarding the employment and retention of staff, how we hire, what quality of staff, what is our selection criteria, all these are part of the control environment, the foundation on which the control structure is built. The vacation policy, scheduling of vacations in the delivery department, this is a very specific activity and it is called not a component of control environment, rather it is the control procedure. Who should sign a check above $3 million? That's control procedure, not control environment. Who would sign a purchase order above $10 million? This is control procedure, not control environment. These three are the components of control environment, but D is control procedure. This is control procedure. This is control procedure. So hence D is the answer. Okay, next. Wadi's company sells 3 years extended warranties as separate performance obligation when it sells appliances. Remember, there are two types of warranties. One is the assurance type warranty, which is sold with the good. Other is called the separable warranty, which is given in this case right here, called service type warranty. Service under the warranty is performed by an independent repair technician under the contract with Wadis. Based on experience, warranty costs are estimated to be 30 for each appliance sold. When should Wadis recognize these warranty costs? Remember, under the assurance type warranty, warranty expense is considered on the date of sale. But in case of the warranty you see here, which is service type warranty, it is only recognized, please put in your head, it is recognized when the service calls are performed. On performance, the revenue is recognized on such a warranty. Whereas for the warranty which is assurance type, it is charged as an expense with the sale of the item when it is sold. So this difference must be kept in mind. Next, what is a control activity related to internal control? Control activity, how is it defined? An activity that helps to ensure that management's instructions intended to limit risk to the achievement of the organization objectives are carried out. Control activities means management instructions are followed. This is a very good description of internal control. We discussed this also under the section E in detail. So this is a good expression of what an internal control or control activity is. The support that the board of directors provide to the audit committee, this is not a control activity. Method of recording, summarizing and reporting financial information, this is a process, not a control activity. An action that is taken by an auditor to obtain audit evidence, that is the audit procedure, not a control activity. The work auditor performs in a specific way, it's audit procedure. So we have good reason to reject BCD. A is the answer. The term agency, what does it mean? First of all, when you talk about large listed companies, there is a divorce. There is a separation between ownership and control. Ownership rests with the shareholders. Control is in the hand of directors and management. Owners are outside the business, millions of miles away, but control is exercised by the people selected in the board or board elections. So this divorce exists in large public companies. This is called an agency problem. Ownership is separated from control. Hence, those who have control, they do not have ownership interest, so they may play with the money. This is called the agency problem. Divorce. A problem that arises due to the method used to compensate management. This is not an agency issue. Problems that can arise from the use of outside agents to negotiate international deals. You can sense the idea from the statement. This is not an agency issue at all. We're talking agency issue, agency problem with regard to large listed companies. The problem that arises due to the fact that the managers of the corporation and the owners of the corporation, they are different people. Managers are not owners and owners are not managers. So this divorce between ownership and control is agency problem. And that's why we need external auditors. That's why we need strong regulations to bridge this gap of separation between owners and control. What about D? Legal problems caused by the use of independent contractors in the place of employees. This apparently looks like an agency arrangement, but when we say agency problem specifically, this refers to divorce between ownership and control. People who own the business are outside the business, and those who control, they are not the owners. So this is the problem of agency. Next, a firm uses a centralized computer system that allows its traveling sales personnel to directly enter new orders and to query the database on old orders. Your sales team is in the travel, so they can access the system from outside. So there are clearly some risks of accessing the system from outside. To maintain data integrity in this place, it would be important to have, there is no issue of backup. There are external logins to the servers. This issue involves certain hacking or problem, maybe the data leakage. For this, organization should have employed some encryption standards or encryption systems, so that if the information is intercepted by any hacker, they will make no use of it, or they are unable to make any use of it. So they have to make some arrangement for encryption. Uninterrupted power supply is not an issue. Even password protection is not an issue. The issue is that the servers are accessed from outside, so we fear that the information, the data, our unique data, it might get hacked. So for this we need encryption. We discussed this in quite an extensive detail. Raw material we need to purchase and the ending inventory separately. Do we have sales? No, we have production. That's a good thing. We will start directly from production, and from production we can work around. It says that we need for the month of September. I told you, if you need September, a month immediately following September, and a month immediately preceding September, and put on the numbers we have. We have September 13,000, October 10,000. It says company produces a product that requires 2 pounds of raw material. The company forecasts that there will be 6,000 pounds of raw material on hand at the end of June, which will be the opening stock of August probably. And it further says, at the end of any given month, the company wishes to have 30% of next month's raw material requirement on hand. That's the policy related to raw material. The company has budgeted production on the product for the month of July, August, September. This is given. So if you multiply each of these with 2, you get material needed for production. So in September we need 26,000 pounds of material. In October we need 22,000. And in August we need 24,000. This is the material needed for production. We also have a policy to follow for closing stock. Closing stock each month is 30% of next month's requirement. 30% 26,000, 7,800. 30% of 22,000 gives you 6,600. And you deduct the opening stock. This closing stock in August is the opening stock in September, and that's you do simplify. 26,000 plus 6,600 less 78 gives you 24,800. This is the quantity you are going to purchase, 24,800, right here. And what is the closing stock? It further says closing stock right here is 66,000. Perfectly matched. So this is what you're going to purchase, and this is what is going to be closing stock. If you follow the formats, the formulas, you will find things much more easier. Next, again a bigger question, and my recommendation would always be to see what is needed. How much cash will be paid to suppliers in March? Just specifically this. Payment to suppliers, clearly it will involve from purchases. And what is the policy related to purchase? It says, this is it. This is what you need to mark. This is how you save time. What is needed and where do we need to look for the information? 30% of the purchases are paid in the month of purchase, and balance 70% is paid in the following month. So how much do you pay to suppliers in March? First of all, what you pay to suppliers in March is 30% of March purchases and 70% of February purchase, because 30% of Feb purchase was made within Feb, 70% will be paid in March. So 70% of 5,000 is 3,500, and 30% of March purchases is 3,600. Adding these two will give you 7,100. This is the total payment made. See, we saved a lot of time by not reading what is not necessary. So 7,100. This is the answer. And the next question will require you more. Now you need to read it. How much cash will be disbursed for operations in March? Now we have to read the whole question to see where we have different payment system. Sales clearly is a system of inflow. The following information pertains to work company. We have sales and purchases for Jan, Feb, March. 30% of purchases are paid in the month for cash in the month of purchase, and the balance is paid the following month. Cash is collected from customers in the following manners: 40% month of sale, and 60% next. This is again related to inflow. Boy expects to incur labor cost equal to 15% of sales and other operating cost of 15,000 per month, including 4,000 depreciation. Depreciation is a non-cash expense. We don't pay anything for depreciation. So which means 15 less 4 is in fact 11,000 for operating cost. And that doesn't mean 11,000 is the answer. That's just operating cost. We have to see there are three types of cash outflows. One related to purchases, that is paid to our suppliers. Second related to operating costs. And third related to labor cost. So we have to find these separately. In the month of March, we just solved this previously. This is what we pay to suppliers in March. 5,000 70%, 12,000 30%, 7,100. This is right here. Operating cost, it says it is 15% of sales in March. Your sale was 20,000, right? So 20,000 is 15%. That is fairly straightforward. 3,000. So that was labor cost. That was labor cost. 3,000. That was the labor cost. That is 20,000 multiplied by 15%. Regarding operating cost, 15,000 is paid, out of which 4,000 depreciation charge to income statement. So basically 15 less 4, 11,000 is your operating cost paid in cash. So what is the cash disbursement for operating costs? These are all operations. So these three categories, 7,100 plus 11,000 plus 3,000. The total gives you what? Let me add these up. 7,100 plus 11,000 plus 3,000. Total 21,100. That is C. C is the answer. Next. Financial performance measures such as return on investment and residual income. They are what type of indicators? They are not external. There is no such category as non-current, lagging or leading. Remember the indicators that relate to the past information, that have historical perspective, focus on the short term. They are called lagging indicators. So return on investment, past performance, historical performance. Residual income, historical performance. So they are lagging indicators. Leading indicators, they are long term. They could be financial and non-financial. They look to the future. So here the answer is lagging, that is A. Next, it relates to cash flows. During 2X7, Beck company purchased equipment for cash by paying 47,000. This is investing outflow, $47,000, and sold an equipment with a carrying amount of 10,000 for a gain of 5,000. An item that was in the books for 10,000, you sold it at a gain of 5,000. That means you sold it for 15,000. So this clearly is an investing inflow. 15. How should these transactions be reported on Beck's statement of cash flows? Cash inflow 5,000 from investing. No, there is no such 5,000. 15,000 inflow. Net cash outflow 42 from investing activities. Net is not 42. Net is less than 42. Cash inflow from investing 15. Yes. And cash outflow from investing 47. Perfect. That is the answer. Inflow outflow separately given in this example. Next.